The automotive sector is the one to watch. I want to bring to the show my next guest this evening, Yousef Alshammari, Editor-in-Chief, C Markets. Good evening, Yousef, and thank you so much for joining us.
Good evening, Alexandra. Thank you for having me.
Yousef, I was just talking with my previous guests. There is a little bit of optimism on the energy market, both from single stocks point of view and, of course, WTI and Brent point of view. So far, WTI trading $33 per barrel, 0.4% higher, and the Brent 0.7% higher. Do you believe this optimism is going to persist in the medium to long term?
Well, absolutely. Currently, with the rally in oil prices that we saw over the past couple of weeks has been mainly driven by reopening economies. In fact, the reopening of economies it happened quicker than what the market was expecting. There was high uncertainty when economies will reopen and when fuel demand will come back. Currently, the gasoline demand is rising. As you can see, the United States refining throughput rose by about 500,000 barrels, and in the Eurozone, in China, and we are actually seeing a gradual increase in gasoline demand in May compared to its level in April, and that has been a major driver for oil prices over the past couple of weeks. One important thing also is that, as we all know, the OPEC cuts that was implemented in May, and there was extra additional cuts from Saudi Arabia and other GCC countries, all removing as much as 35 million barrels a month starting from June. That has also been a major driver, combined with the reopening economies, to the price rally that we have seen. And I believe certainly as economies continue to reopen more and more, we will be seeing the oil trends continue to grow up gradually.
I want to talk about a China factor. Only a few days ago, we saw that China scraped its 2020 GDP forecast for obvious reasons. Certainly, the coronavirus that caused many problems all around the world. Of course, not only in China. How much of a factor is going to be China in 2020 for the energy market, since it's one of the major importers of crude oil?
It continues to be, I don't want to say the largest factor, but in fact, it's effectively one of the largest factors influencing oil demand, is China. Just look at last week when China just decided not to put any target on its economic growth. Oil prices had a bit of a slight decline. So Chinese demand is a major factor in oil demand and the growth of oil demand. Currently, the expected growth in Chinese economy this year is about 1.2%, compared to about 6% before the crisis would have happened. But currently, what we see, there is some promising data already coming from China, is that showing the gasoline demand is almost as much as its level before the crisis. Of course, we can't take the aviation or jet fuel demand currently into the picture, but it accounts for only 6 to 7%. But looking only into the ground transport demand, it's effectively coming back much quicker than expected, and I believe it would continue to drive the let's say the bullish sentiment in the oil markets moving ahead in the next couple of months.
As you said just a few minutes ago, Saudi Arabia contributed with important output cuts, of course, to the oil price increase, that's for sure. Also the OPEC Plus members, no doubt about it. But what do you expect from OPEC members in the upcoming meeting? Do you believe now, considering the consequences that we saw of the price war between Saudi Arabia and Russia, let's call it the squabble, this squabble is over already?
Certainly, I think that's been already something in the past. There's been a competition over the market share, and main reason was there were a lot of reasons that now do not exist. There was, number one, there was no bottom for the oil price on in fact, the decline in demand. That was not understood in March. Now we have established the bottom for the decline in oil demand. Shale, United States and North American producers have already contributed to the decline in production. So the market share that the Russians were worried about is actually secured. You can see all OPEC producers contributing to the cuts. So in fact, all their market shares are being retained. And I believe I don't think we will see that kind of market competition, or what you call the price war, would happen again in June, or even in the near future. But one important thing is that now it's the compliance issue. Today, Russia has announced that its production level has reached to about 8.4 million barrels a day. That's what that actually meets its OPEC Plus agreement. And I believe other members in the organization, including Iraq, Nigeria, and in fact all of the OPEC Plus alliance, they would have to now monitor their compliance levels and try to achieve as much compliance as possible, giving the extra cuts measures taken by Saudi Arabia and other GCC countries.
Let me ask you one final question. Of course, it's regarding the U.S. Shale oil producers. Certainly, we saw the last data, stockpiles in the U.S. decline significantly, and of course, many shale oil producers kind of halved their refineries. So when do you expect the U.S. shale producers and, of course, major companies to be back on track as they were ahead of the coronavirus outbreak?
Well, number one, now with the price rally that we're seeing over the past couple of weeks, I believe the shut-ins in the U.S. are peaking. So I don't think we will see more shut-ins of major fields as much as we saw previously. So currently, the largest number of barrels expected to decline as a result of the shut-ins is expected to be around no more than 2 million barrels per day. So currently the U.S. production is about 11.5 million barrels per day, taking into account the declines as a result of both major shut-ins and natural decline due to the decline in oil prices. Of course, the return to the market would not be as easy as it used to happen before. Why? Because many of the shale producers have filed bankruptcy, and also the shut-in of oil fields is not an easy process to return them back to normal. In fact, some of these fields can suffer from permanent damage, and they would require major maintenance before their production can come back to normal. And that would require, the most important message I want to convey here, it would require investments. And to get these investments back into the required investments back into the industry, you would need a price of at least $50 per barrel for a sustained period of time. So I would expect shale to come back into its production level before the crisis to take from 1 to 2 years, provided that oil price would stay at least $50 per barrel.
All right, fantastic to catch up with you. Yousef Alshammari, Editor-in-Chief, Sea Markets. Thank you for joining us, and thank you for your analysis.
Always a pleasure, Alexander. Have a lovely evening.
Thank you, Yousef. Well, we're heading for a very short commercial break, but stick around because up next is the stocks to watch.